Welcome to Chapter 1.5, the final piece of our puzzle on market architecture. Have you ever really stopped to think about who's in charge of the financial markets in India? I mean, who writes the rules, and maybe more importantly, who makes sure everyone actually follows them? Well, today, we're going to pull back that curtain and look at the framework that protects every single investment you make.
I mean, really think about it for a second. You take your hard-earned money and put it into the market. So, who's looking out for you, making sure the game isn't rigged? And it's a fair question. Why do we even need all these rules? Why can't the market just run itself? Well, the answers to these questions are the very foundation of becoming a smart and safe investor.
So here's our game plan. First, we'll tackle the big why. Why regulation is absolutely essential. Then we'll meet the key players. You've got SEBI, the market's watchdog, the RBI, the guardian of the whole system, and the income tax department, who is kind of the official scorekeeper. And finally, we'll wrap it all up with a practical playbook for you, the investor.
All right, so first things first. Before we can even talk about who the regulators are, we have to understand why they even exist. I want you to imagine a market with no rules. It'd be the Wild West, right? Total chaos. Regulation is what builds the very foundation of a fair market so that everyone, from the biggest institution to the smallest investor, plays by the same set of principles.
You can really boil it down to 4 key jobs. Number 1, making sure the market is a level playing field. Number 2, protecting you, the investor, from bad actors and fraud. 3, and this is a big one, containing systemic risk. Think of this as a safety net so one bad apple doesn't spoil the whole bunch. And finally, when you put all of that together, what do you get? Public confidence. And that confidence is the glue that holds the entire economy together.
Okay, this is a really critical point, and I want you to let this one sink in. Regulation is there to make sure the game is fair. It does not guarantee you'll win. Its job is to ensure a transparent and just process. But the outcome of your investments? Well, that's still on you.
So, if regulation is the rule book for the game, then who's the referee on the field blowing the whistle when someone's out of line? Well, in India, that's SEBI. You could think of SEBI as the primary watchdog of the securities market. Its entire job is to watch every move and make sure everyone is playing fairly.
SEBI stands for the Securities and Exchange Board of India. Basically, if it's a stock, a bond, or a mutual fund, anything you can trade on the market, SEBI is the one in charge. And its mission is crystal clear and has 2 parts. First, protect investors like us. And second, regulate all the other players in the market.
So what does SEBI actually do all day? Well, first and foremost, its number 1 job is to protect your interests. It also regulates the whole ecosystem, the stock exchanges, the brokers, the companies that are listed. It's also the market's detective, actively hunting for things like insider trading and market manipulation. And finally, it's always working behind the scenes to make our markets better and more efficient.
Okay, now let's zoom out. We've been focused on the stock market, but let's look at the entire financial system. If SEBI is the referee for one specific game, then the Reserve Bank of India, the RBI, is like the commissioner of the entire league. Its job is much broader. It's to make sure the whole financial system stays healthy and stable.
Now, you've definitely heard of the RBI. It's our central bank, and its responsibilities are huge. It manages the country's monetary policy, things like interest rates and how much money's out there. It supervises all the banks. So you see, while SEBI is laser-focused on the markets, the RBI is looking after the stability of the entire financial machine.
You hear these terms on the news all the time, right? Repo rate, CRR, SLR, but what do they actually do? Well, think of them as the RBI's main control panel for the economy. The repo rate influences the interest rates we all pay. By changing it, the RBI can tap the brakes or hit the accelerator on the economy. And CRR and SLR basically tell banks how much money they have to keep on the sidelines, which affects how much money is available for loans. It's all about managing the flow of money. So we've got the referee, SEBI, and we've got the lead commissioner, the RBI, but who keeps the official score? That would be the income tax department. Look, it's simple. Anytime you make a profit from your investments, that's considered income, and that income is subject to tax. It's not a suggestion. It's a fundamental part of the system.
Now, when it comes to taxes on your investments, it really boils down to one simple question. How long did you hold the asset? For listed stocks, the magic number is 12 months. If you sell within 12 months, your profit is a short-term capital gain. If you hold it for more than 12 months, it becomes a long-term capital gain. And believe me, that one distinction makes a world of difference.
Okay, let's look at why this matters so much.
Short-term gains are taxed at a flat 20%, but long-term gains, they're taxed at a much friendlier 12.5%. And here's the real kicker. For long-term gains, the first 1.25 lakh of profit you make each year is completely tax-free. That's huge.
This is where it gets really powerful. Let's say you made a 50,000 rupee profit. If you sell right at the 12-month mark, it's a short-term gain and you'll owe 10,000 rupees in tax. But if you just wait one more month, it becomes a long-term gain. And since it's under that tax-free limit, your tax bill is zero. Nothing. That's a 10,000 rupee difference just for being patient. This is why understanding the rules isn't just about compliance. It's smart strategy.
Okay, so we've met the regulators and we've looked at the rules. Now, let's bring it all home and talk about the most important player in this entire game, you. How does all this information fit into your personal playbook? Because knowing the landscape is one thing, but understanding your role within it is what truly matters.
The key thing to remember is that these three bodies don't work in separate silos. They are like three legs of a stool. SEBI provides fairness in the market. The RBI provides stability for the whole system, and the Income Tax Department ensures everyone is complying with the law. They all work together, and if you take one away, the whole thing gets wobbly.
So, what's your role? Well, it's a two-way street. The system gives you rights. The right to accurate information, the right to have your complaints heard, and the right to use every legal tax benefit out there. But, and this is a big but, it also gives you responsibilities. You have a duty to report honestly, to follow the rules, and, most importantly, to be aware of the risks you're taking on.
You know, one of the biggest mistakes I see new investors make is getting all their focus on potential returns while totally ignoring the rules. But hopefully you can see now that understanding this regulatory landscape isn't just about avoiding trouble. It's a fundamental part of building a smart, successful, and long-lasting investment strategy.
And that brings us to the end of our deep dive into market architecture. So let's do a quick recap. We've learned that regulation is the bedrock of trust and fairness. We know that SEBI polices the market, the RBI manages the whole economy's stability, and the Income Tax Department makes sure we all comply. And most importantly, we know that your role is to be an informed and responsible investor.
So I'll leave you with this final thought. Now that you understand the rules of the game and you know who the guardians are, the real question for you isn't just about what you should invest in anymore, it's about how you choose to participate. So, are you ready to be a responsible market participant?